Good morning, all. Thank you for joining us on this Saturday morning. So, just to quickly introduce, right, we'll be covering the certain manufacturing themes which are prevalent, right? But just a quick disclaimer before starting the webinar that whatever the stock ideas that we'll be discussing today, so those are just for the educational purpose. Do your own due diligence or reach out to your financial advisor to before investing on those ideas, right? So there has been good long-term structural story which is developing in India, right? And we are quite bullish on that story for some time now, right? And we feel that this is a story which has the capability to compound at a very good rate of more than 20-25% CAGR over next 10 years, right? So we feel that we'll just take you through some of the key changes that has happened in the manufacturing domain in the past, right? And why we are look to be placed so optimistically on the entire global landscape, right? And then I will be also discussing about some of the key reforms being done by the government, some of the key tailwinds to the sector which is already there. And then my colleague Vijay will be discussing about the advantages of having a booming consumption economy, right? And then we'll also be discussing about how to create a anti-fragile portfolio, which can help you to withstand the market volatilities and can help you to achieve a dream of being financially independent, right? So just to start with, right? So just to give a quick overview of what has happened with the manufacturing sector in the last 75 odd years. So since we have gained independence, right, and the share of the services and manufacturing in the economy was manufacturing was at around 10-11%, services was close to 20-22 odd percent, right? Now 75 years fast forward down the line, we see that the services sector to have an increased exposure to the entire GDP to the tune of 55%. But if you talk about the manufacturing, so manufacturing has not been able to gain or grow at the same pace. And if today the manufacturing contribution to the entire GDP is just close to 17 odd percent, right? So if you compare that with our emerging market peers, right, like for example China, which is currently at around 27% contribution coming from the manufacturing side to the GDP. Vietnam is again close to 26-27 odd percent. Even the Bangladesh has a GDP contribution to the manufacturing higher to the 20 odd percent, which is around 20-22 odd percent, right? So basically somehow we missed building an entire manufacturing ecosystem, and that was mainly because we have some red tapeism in the economy. We don't have any meaningful trading partners. We didn't sign up with any we didn't sign up any meaningful trade agreements with the larger nations. Then we didn't have a component ecosystem in the place. So obviously we have built a component ecosystem or industry ecosystem for auto industries in last 20 years, or let's say chemical ecosystem in the last 10 15, like 7 8 odd years. But bearing those two industries, for most of the industries we don't have the component ecosystem in the place. Then we didn't have a workforce which is ready to go and produce the high end kind of manufacturing that is required. Then we have certain challenges around the infrastructure side. We didn't have the last mile connectivity on the roads and railways. Plus, we didn't have the expenses on the utility side, or the transfer of goods from one point to other point was quite high, right? So those were a few huge key challenges which impacted the growth of manufacturing in the economy. But just to do a broader calculation, how we are projected to grow forward going ahead. So even if we take a very conservative growth pattern for India, let's say next 10 years, we are expected to grow at a rate of 10-12% on a nominal side. So if you look at the current size of the economy, it's around $3.6 trillion, the organized one. The unorganized sector is again will be adding close to $600-700 billion to the entire economy. So on a size of 4.2 trillion economy, if we can manage to grow at a rate of 10% to 12% on a nominal basis for let's say next 10 years, so the economy will be close to 10 to 12 trillion dollars, right, in the next 10 years by 2033, right? So, and if the government reforms and all the tailwinds which is there in the sector, which plays out as we have thought of, so the share of manufacturing is expected to improve from 17% currently to 20%, maybe 10 years down the line, right? Which is again lower than the global average. But let's say if we manage to bridge the gap slightly, so the share of manufacturing will increase from 17% currently to 20%, right, in the next 10 years. Now, 20% of 10 trillion is roughly around 2.4 trillion dollar of manufacturing output that we'll be doing, right? So coming from a $600 billion manufacturing output that we're currently doing to 2.4 trillion dollar of manufacturing output, we are expected to do 10 years down the line. It's a 3 to 4x kind of growth that we'll be seeing in the manufacturing domain in the next 10 years. Now, if the sector itself is expected to do a 3x kind of growth, then there is a high possibility that there will be winners in the segment, right? Winners in the sector or winners in each of the industry which is under the manufacturing side, that will compound and grow your money at a rate of more than 30 or 25 odd percent, right, going forward. So let's just understand what are the key positives for the economy which is there and which is only there with India currently and not there with any of the other geographies. So if you can just move to the next slide, please. Yeah. Now, if you look at the share of manufacturing landscape, if you look at the current manufacturing landscape, so if you look at the total working population that we have currently in the economy, right? So the total working population is around 80 CR, right? Which is which is a part of the labor force or the working class, and we are expected to add another additional 20 CR population in the next 10 years, right? So in the next 5 years, we'll be surpassing China as an economy which has the largest workforce. And then if you also look at the kind of production that we'll be doing, so we have the cheapest production cost, not production cost, but the cheapest labor globally available, right? So this is the same thing that has happened to the China around 20 years back when it started opening up the economy and inviting global manufacturers to come and set up a base there in China, right? So China used to be the cheapest producer in terms of manpower and labor at that point of time, and then over the years, companies like Foxconn, Jabil, and all came and set up the shops in China and set up the manufacturing presence. And China also didn't have any ecosystem at that point of time. But since they started with it, now 20 years down the line, it is the only place which has the entire ecosystem required for manufacturing presence, right? So basically, this is what expected for our economy is. And then once we manufacture all those products, we need a booming booming population to consume that the produce that we'll be having, right? So currently, if you look at the GDP per capita income, it's slightly closing to $3,000 $3,000 per capita, right? We have currently at, and in the next 10 years, hopefully, will be closer to $10,000 per capita GDP income, right? So once we move ahead in the value curve and the GDP per capita will be increasing, so there will be an increasing consumption of high value add items, be it building materials, sophisticated electronics item, or something like that. So the consumption will first be domestically, and then once we'll start producing the surplus, then we'll be exporting to the world, right? So that brings me to my next point, how India can become the factory to the world. So just to discuss those things, Prabhu, if you can move to the next section of the presentation. So now, in the past 7-8 years, there were few reforms being pushed, right, which was long needed in the economy. So starting with a PLI, where the government is trying to incentivize a chosen few companies in the industry and the sector to make them build for the world, right? So they incentivize this chosen few companies to operate at a very large scale, and that has played out we are just doing a very low end kind of value add today, right, under the PLI scheme. But once the ecosystem will place, right, once we have the necessary support and infrastructure in place, we have the skilled manpower in place, so then the value add segment from the manufacturing that we're currently doing is also expected to go up, right? The next is the transport cost, right? So currently the logistic cost in the country is close to 16%, which is the highest, which is again on a very higher side, right? If you look at the global average of logistic cost, it's under 10%, right? So the government has come up with PM Gati Shakti Yojana, where they are building roads, railways, trying to push up the infra by having the wires and cables connectivity to facilitate the electricity, and they're also giving the internet connectivity and connecting villages at the last mile to have a seamless movement of goods at a very low cost, right? So the expected is that maybe in next decade or maybe 70 years down the line, the percent of logistic cost as a share of GDP should come down to 10% from 16% currently, right? And if you look at the kind of growth that we are seeing and we have come in the last one decade, so in 2010 we used to build close to 10 to 11 kilometers of national highways or roads per day. Today we are clocking around 36 kilometers of roads per day, and the government target is to be like you know doing around it doing at least 40-45 kilometers of roads at the end of this financial year, right? So basically we'll be seeing 20,000 kilometers of roads being constructed every year from now onwards, right? And that's a very massive connectivity we are building for the movement of goods and inventories from one point to another. So these are the key pointers, like which will be propelling and making in making the products in India more affordable and competitive to the global peers, right? Now there is a growing shift which is happening, right? And Western economies are trying to reduce their carbon footprint, right? And earlier they have turned towards China to manufacture for them. So they are the original innovators. They manufacture, they create the prototype, they create the product. But when it comes to the large scale manufacturing, they turn towards the emerging market, right? So they have been getting in manufacture from China, some bit of it from Vietnam, Indonesia, and all. But now India is going to take up that center stage, mainly because after COVID they have known the lands of China could be costly for them. And they wanted to diversify their supplier base, and also because of post Russia-Ukraine war, right? So the energy cost has gone up substantially higher in Europe, right? So the manufacturing at larger scale has become kind of unviable, and they are again looking to India to take up some of that manufacturing activity. So these has been a key shifts which is coming from the Western world side. And again, government is very very adamant towards signing up some of the trade agreements, and we have been hearing about the trade agreement which we are signing with UK, right? So once that trade agreement is in the final step, that will be done, that will open up for the trade agreement signing with the European Union, right? Once UK and European Union will be done, then we have a trade agreement with let's say US, right? So that will again give a market for our products to export outside India, right? So currently if you look at the share of global trade, right? China has a commanding share of 29%, while India is just under 3%, right? So there is a long way to go. Some of the share migration will be coming out of China, will be going to India, right? And we'll be seeing the share from India to grow from 3% to 4 or 5 or 6% also, right? Going forward. So if you can just move to the next slide, we can discuss about some of the key reforms which government has done recently, right? So just starting with 2014, government has come up with Make in India concept, but then they soon realized that it's a very broad theme, right? And we need to find out champion industry. So they find out industries like chemical, pharma, automotive, then machinery, and industrial machinery and all, to where they can put the focus and make the ecosystem very conducive for large scale manufacturing, right? And then they come up with PLI in 2019. They have come up with a FAME in 2014 to 19 in the first phase, and then the FAME second FAME 2 they introduced in 2019, which was extended now to 2024 to incentivize and faster the adoption of EV in the economy, right? So all those objectives and efforts being done by the government, but the main seriousness and the government thrust toward the production was seen in 2019 when government decided to cut the rate, right? So they have already reduced the rates from 30% to 22% for the corporates, right? And just to incentivize setting up the new manufacturing plant, they have reduced the tax rate further to 15%, which is lowest actually if you look at any of the larger economies, right? So what it does to a manufacturer is that it gives them incentive to reap the profit, and then bring back the profit back into the business, because the tax rate is lower, and then that sets out the engine which continues to manufacture more and more, right, at a scale. And then again we have a lot of incentives being played out. So just a moment. Yeah. So we have we have spent a good time signing up those FTAs and all, and those are a key figure in bringing the export making India the trade deficit which is currently we have with other countries to go down substantially. Now if you can move to the next slide, please, we can just have a look at some of the key investments being done in India. Yeah. So if you look at the export as an opportunity, right? So currently we are importing close to $190 billion worth of products, right? And currently we are just exporting close to $24 billion of worth of products. But if we are on a track to manufacture close to $2 trillion in the next 7 to 8 years, right? And let's say we are just moving ahead of $1 trillion in the next 7 8 years. So we can see our exports going up to $150 billion in the next by FY28 maybe or so, right? So that's a 6x kind of jump we'll be seeing in the exports in the next 7 8 years. That will be very good for economy, as it will maintain the currency balance for us. And again, the value add and the higher relation that we get from the corporate from the export will add back to the corporate profits, right? And if you look at some of the investments being done by the major companies, right? So this is the same thing that has happened with China also, right? 20 years back. Now today, if you look at the investment commitment done by global MNCs like Xiaomi, Videocon, Foxconn, Samsung. So all these companies have been started to invest in the country. And going forward, also we feel that the investment intensity will only go up from here on, right? And once we have the supplier base, we have the technical capability to produce at a large scale. So this investments will again is bound to go up going forward. So Prabhu, if you can just move to the next slide, please. Yeah. So these are some of the key investments being done by done in different sectors by the government, right? So we have already seen investments more than 3,600 billion rupees, right, to boost the domestic manufacturing, to reduce the import dependence, to improve the value chain across the segment. So the government is very hard bent on reducing the trade deficit with respect to at least in the manufacturing side. So the majority of the trade deficit is from the energy side, which we can't do anything about. But at least the $60 billion of trade deficit that we run on the electronic side or manufacturing side, that we can do, and we can look to reverse in the next 4 or 5 years. And these all PLI schemes that we have been seeing, that's a very small step in that direction, but it has a long way to go again, right? And there are projections which are placed, which show that going forward we'll be able to achieve that. So if you can just move to the next slide, Prabhu, please. So clearly the government focus is enhancing the manufacturing domain, right? And if you look at the current trajectory, right? So till 5 6 years back, we were doing close to $75 billion of manufacturing production, right? The entire electronics manufacturing space was close to $75 billion. Currently, it's around $100 billion. In the next 7 8 years, we are going to see this electronics manufacturing industry to grow at, let's say, $600 billion on a conservative basis, or let's say $800 billion on a very aggressive basis, right? The mobile manufacturing, which is again a 50% of the entire domain, is 30-48% of the entire domain, is expected to grow 4x 5x in the next 7 8 odd years, right? And government is very much adamant on building a $1 trillion of manufacturing industry in the next 10 years. So the entire industry can see a 3x growth, and or 33% kind of CAGR over the next 4 5 years. And we have multiple opportunities from that space, right? Which can look to compound in the same way. We have added some of the stories that my colleague Vijay will discuss with you later on, and how that can be a part of increasing the overall portfolio returns. So just to move on and look to conclude this second section. So I'll just like to mention that when China started in 1980s or till mid 2000s, so it opened up the economy, and then companies like Foxconn, Flex, or Sanmina, they come and invested in China. And if you look at the company's top line growth rate for the next 10 years, right, because the industry itself was growing at such a rapid pace, these companies grew top line in the north of 50% for a decade, right? So we have those sort of opportunities itself in India, and it's not an untested story. If you look at the growth, China plus one has already played out in the past with the chemical industry, right? In 2014, when the Chinese rivers were running red because of all the industrialization and the chemical fluent being discharged, So they put up a effort to curb the chemical production in China, and again West come looking to India for manufacturing the chemicals for them, right? And that led to the setting up of entire chemical value chain in India, right? And from being a generic manufacturer of chemical to specialty chemical manufacturers, we have seen a lot of companies grow in size and in market caps, right? So just to put things into perspective, look at the top 15 companies, how they have done in the last 9 years in the China plus one phase. So this company has grown their top line by 24%, their bottom line by 35 odd percent, and their profitability, the stock price CAGR by close to 50% over the last 9 years. So that story has already played out in one industry. That story is going to repeat itself, playing out in many different industries this time, right? Be it building materials, be it electronic manufacturing, or be it contract manufacturing at a large scale. So we have those stories in place. We just have to be patient with we're patient with the execution, and we have to see how we can take advantage of that in our portfolios. So for the next section, Vijay will be discussing about how the consumption will be a good way to look at this manufacturing story, and what are the some of the themes that one can look forward to have in the portfolio going forward. So over to you, Vijay, now. Thank you.
Yeah, thank you, Prabhat, for taking us to the manufacturing landscape and how the development is going on from the multiple sides. Now, the manufacturing boom that is going to be there for the next decade, so that will also heavily influence the demographic profile, and it will also trigger the consumer behavior change at an overall level at the economy. So now we will look at the impact of manufacturing boom on these two themes. So first, we will look at the household distribution, income distribution, which is a demographic profile. So in the left side, if we look at the household income distribution chart, so if we combine the bottom two, the $10,000, less than $10,000 GDP per capita, so we currently have around 30 crore households as per the last data, and 75% of those households have less than $10,000 GDP, less than $10,000 mark. So we can see this thing completely going to the transforming if we project for the next 10 years. So on the right side, we have captured the data for the next 10 years, how it will look like in the 2031 or 2032 financial year. So this bottom of that 75% will shrink to almost 47%. The majority of the population or households will be upwards of $10,000 mark. So that will trigger a new consumption cycle. That will also trigger a new consumer behavior and the spending cycle that we will uncover in the next slide. Yeah. Please move to the next slide. So the household shift or the demographic profile shift that is coming because of the income going up and also the GDP per capita increasing from 2.2K mark to the almost to the 5.2K mark. So in this slide, we have captured how the GDP per capita will improve by almost 8.7% CAGR in the next 10 years. Remember, these are very conservative numbers. So we at least expect the double-digit kind of nominal GDP growth as well as the double-digit growth in the GDP per capita side. We are projecting our economy to almost around $8 trillion on the conservative side. Of course, we are bullish that it should at least happen in the double-digit mark. Also, if we look at the retail market, so the retail market is around $781 billion today, around 41% of the total GDP. That will almost reach to $1.8 trillion mark, which will be around 40% of the $8 trillion mark that we are projecting in the next 10 years. The interesting thing in the retail side will be if we dissect the portion in the grocery and the non-grocery side. So basically, grocery is a part which is an essential part for the human beings. So the projection is that the grocery part will only compound at 6.5% CAGR. It will grow from $500 billion to $930 odd billion in the next 10 years. But the magic will happen in the non-grocery side, which is a consumer discretionary item, which will grow. The space will grow itself at the 12.2% CAGR and reach around $900 billion mark in the next 10 years. So this is a consumer shift which will come once the GDP per capita improves from $22 or $2,200 mark to the $5,000 odd dollar mark. And it will also trigger the huge consumer discretionary boom cycle, which is again led by the manufacturing boom. But to fuel these two themes, we would require a lot of capital. And in India, the main source of capital will be coming from the credit side. So we will also see the credit boom, and we are targeting in the next slide, please. Yeah. So in this slide, we can see like our overall GDP per overall credit to GDP mark is around 57%, and we are expecting the loan book growth, or let's say the credit growth, to grow at around 17% and reach the ideal mark of 100%. So we will have, let's say, if we have $10 trillion of GDP, so we will also have $10 trillion of credit in the next 10 years, and that will in turn fuel the manufacturing plus the consumer discretionary boom that we will witness. So these are the clear three themes that we have uncovered. First is the manufacturing, as highlighted by Prabhat. Second, the consumer discretionary theme, and third is the financial boom, which is the fuel for these two themes. Now we'll move to the application part, and we will see like if these three themes are going to shape up the next decade. So how we can take advantage of that, and how we can also include the businesses in our portfolio. So moving to the philosophy slide. So at RH, we strongly believe in the systems and process. So we have also developed this RH multi-bagger framework in the last 5 years. So those of you who have been our regular viewers of this webinar series, though they might be familiar with this framework, but for the new joinees, I will just explain it in a brief. So basically, our multi-bagger framework revolves around the two parameters. One is the growth, second is the valuation. The growth factor, we typically look for the businesses which can compound their earnings, or let's say grow their earnings by 2x in next 4 to 5 years, having the right capital efficiency, higher competitive advantages, which is also the moat, which will protect the business in the down cycle. Second part, or the second parameter, which is the valuation. So we typically buy companies which are trading to the discount to the industry multiple and also the sector leader. So we don't believe in the buy at any price philosophy or buy at any valuation philosophy. So we'll always pick business which is available to the discount to the whole industry and also the sector leader. That is our margin of safety when we are picking any businesses. So combining these two parameters, the multi-bagger framework that we have highlighted, the two parts like growth and valuation. So if we the framework that we have mastered in the last 5 years, we applied in the last bull cycle from FY20 to FY22, which has also generated a very solid return and created a whole lot of wealth creation for our clients. And if we share the last cycle examples, like so we had businesses like Neogen Chemicals, KEI, Dixon, APL, Apollo, and GMM Pfaudler. And to explain like how we applied this framework. So let's take example of KEI. So when we invested in this business in 2020's time, so the initial valuation was around 18x P, and if we look at the current valuation, those are around 30x, 36x P, and we have seen almost a 2x kind of earnings growth in those cycles. So if we combine those if we combine the 2x earnings growth with the 3x kind of multiple re-rating, so we have generated around 6x kind of absolute growth in the particular business. And similarly, we have also seen the multiple expansion and earnings growth in the different businesses that we have highlighted in the slide. So with this same framework, we have also designed our the new strategy portfolio that we launched in somewhere around March 2023. So moving on to that future development. Yeah. So when we were also preparing our portfolio for upcoming bull cycle, so we also applied our the initial manufacturing boom and the consumer discretionary trend on the global side as well, that how the developed economies have gone through that journey. And what we uncovered was very fascinating. So as we have captured in the previous slide, that we will cross around $5,000 GDP per capita mark in the next 10 years. But when we studied the other developed economies, so the trend is not stopping at the in one decade. In fact, if we cross the $5,000 mark, we will see again expansionary boom in the consumer discretionary, NBFC, and the manufacturing side, and it will last beyond $25,000 GDP mark as well. So the trends that we are picking, manufacturing, consumer discretionary, and finance, those are not the single decade themes or single decade trends. Those are the multi-decade themes. So combining these two learnings, we have designed our portfolio that are revolving around these key themes. Yeah, please move to the next slide. Yeah. So the portfolio that we have designed in our strategy is mainly a combination of manufacturing, consumption, and NBFC side. So we like paints, wires and cables, steel pipes from the manufacturing space, which are the domestic manufacturers, and they are also exporting a lot of volumes to the developed economies. Also, they are seeing very solid demand from the export market, especially from Europe side because of the disruption happened in the corona from the China. So the faith of the buyers have been reduced in the Chinese economy, and now they are switching to the India as well. The electronic retail and the fashion retail, these two themes are coming from the consumer discretionary side. And the last is the NBFC, which is the fuel for the manufacturing and consumer discretionary theme. So if we take just example of electronic retail, so the electronic retail business that we hold in our portfolio, so that is based out of Eastern India. We can't disclose the name because of the confidentiality issue and compliance point of view, but it operates in the eastern part of India. And when we entered the business, it was around 22x P on EV by EBITDA multiple. And the sector itself is trading at 45x EV by EBITDA multiple. So the discount is around 50%. So we are expecting at least 2x kind of earnings growth, 2.5 kind of earnings growth in the business in the 5 year. And also we are expecting the multiple relating to happen because of the execution of the underlying thing. And we are expecting at least 5x to 6x kind of single business potential in our portfolio contribution level. Just to highlight that in the last quarter when this particular business posted the results, so it grew its earnings by 50% on the year-over-year basis, and the stock price has already doubled in the last 4 months. Similarly, for the other themes that we have highlighted, also reported very robust earnings, and it has also propelled the overall portfolio price performance for our strategy, and which is again discussed in the next slide, please. Yeah, please move to the next slide. Yeah. So the portfolio that we launched in March 2023. So we have completed around 4 months, and those of you who have been the regular viewers, so they might be interested in the performance, that how we have delivered on the themes that we have identified. So our portfolio has gone up around 35.8% in the first 4 months, and similarly the benchmark has gone up around 19%. So if we compare on the, let's say, if someone has put around 1 crore rupees, so that 1 crore has almost reached to 1.36 crore. And what is the benchmark of 1 crore to 1.19 crore? So the outperformance has been around 17%. What is the benchmark? So that is good. A lot of good improvement from the company's fundamentals and also the multiple re-rating, which has led to this solid price performance. But at RH, we always believe that risk and return always walk hand in hand. So we are also remaining vigilant on the company execution, also the business risk point of view, and also the valuation risk, because the day by day the market is climbing new highs, especially in small cap and the mid cap space that we are quite bullish on. So we are also keeping track of those valuation themes. And in summary, we would like to highlight that the manufacturing, consumer discretionary, and finance are the three themes which are going to stay here not for a single decade, but for the multiple decades, maybe next 4 or 5 decades. So this is a very rewarding opportunity for all of us. But we also have to remain cautious on the fact that this journey will not be smooth. If we are expecting that we can grow 15% each year, so it will never happen. We will always have our down years as well, where we face some temporary phenomena or temporary setbacks. But if we have the longer term investment horizon of, let's say, 5 years, 10 years, or 20 years, so the journey can be quite rewarding one, and the financial independence can be also achieved. So with this, we would like to conclude the webinar, and thank you for listening us patiently. Yeah, over to you, Prabhu.
Yeah, thank you, sir. So before we move on to the Q&A session, so we have an update on the super value aggressive strategy. So I would like the speakers to announce it.
Yeah, Prabhu. So I think Vijay has already covered the performance part of it, right? So just to for there are a few new joinees in the webinar as well. So just for their understanding, so we are already running a super value scheme, and we launched the scheme in November of 20, right? And the last 27, close to 32 odd months, the scheme has given a return of 42, 43 odd % CAGR, right, in the same time frame. And we have the scheme has outperformed the benchmark by close to 20 odd percent, 22 odd percent. So the thing is that, like, the last entire year, right, from October of 2021 to March of 23. So it was an 18 months of period where we didn't see much movement in the index, right, especially on the mid and small cap side. And in fact, at the bottom of it, the index was down close to 33, 34 odd percent from the peak, right? So we have spent the last entire year meeting a lot of promoters, right, and like identifying the businesses which are just affected because of the liquidity concern and the liquidity scenario around it, but the underlying businesses were doing quite well, right? So we try to create a portfolio, like which we can like write for at least next 4 or 5 years. So mid and small cap, or preferably the small cap, is a space where like you don't invest and like forget, right? Because when the cycle will turn, you will lose your entire, like not entire but at least 30-40% of the profit that you have done. You will lose once the cycle turns and you are in a bear cycle, right? So to think slightly in a slightly different manner, we have timed our entry that like we want to enter when the cycle is at the bottom, right? So that we don't have any macroeconomic risk playing in the portfolio. To counter the company specific risk, we have like spent close to a year creating this portfolio, right? So and please understand the fact that when a portfolio is created in a bear market, the quality of portfolio is very, very high, right? And whatever the ideas that we have onboarded, 2025 stocks, they have seen the worst of liquidity, worst of the business cycle, worst of the raw material prices and all, right? And that's when we have onboarded it, right? So what we expect from these companies to do is that at least they will double or triple the earnings in the next 3 to 4 years. And now that we are entering at a valuation where like they are trading at a significant discount to the industry, to the market leader, so there will be a sufficient multiple rating that will be happening in these companies. The return that you will be seeing 34%, right, since inception of the super value aggressive performance. So it's not that the underlying earnings have grown by let's say like 30 odd percent. The underlying portfolio growth will be in range of 10 12 odd percent or 13 odd percent, right? But what has happened that like because since these companies were so depressed, right, when we onboarded, and like when we are nearing to the rate cut cycle, so we are seeing a recovery in those like the prices in a very sharper manner. We are seeing the rating happening in those companies, right? And we expect this rating to continue at least for next 2 to 3 years, right? For example, the P of the company that we onboarded, if it's trading at 20, we expect that P to at least rate to 30-40%, 30-40 P, if the company keeps on delivering like what it has promised us, right? So this is what this is what the thought process behind launching a super value aggressive scheme. It is primarily a small cap scheme. We want it to be right at the point of entry. Also, when we feel that like there is a sufficient growth room when we enter it and enter at the bottom of a bear cycle, right? So typically the return from a bottom of a bear cycle to a peak of the bull cycle is roughly 250 odd percent. So we feel that as we go near to the peak of this bull cycle, like the when we are currently in, so we'll liquidate the entire portfolio and we'll be returning the money to the investors, right? So the only thought process is that whatever the profit that we make in the scheme, at least that profit gets transferred from the demat account of the client to the bank account. So this is what we have thought of, right? And this is what our internal agreement and commitment to the client is also there, that once we'll be reaching closer to the bull cycle, we'll be winding down the portfolio and returning the money back to the client, right? So again, it's not too late for investors to participate in super value aggressive. We feel that sufficient rally has already happened. The scheme is already close to 36%. Most of the the valuation rating which was due from the bottom of the valuation curve, that has already happened. Now the stocks are trading closer to the fair value, right? Definitely not higher, but closer to the fair value, right? So we plan to close the scheme for subscription by the end of this month, right? So if you have any interest, if you are already existing investor in the right horizons schemes, do reach out to the advisor and plan for a discussion around the same, right? So I'm sure this scheme is going to add a lot of value to the client's portfolio. They can allocate a small portion of their portfolio in this scheme, which could be a return seeking portfolio, and over next 4 to 5 years, that return seeking portfolio can look to contribute some sort of gain to the entire portfolio of the client, right? So with that, we can look to conclude it here, right? And if you have any questions, any comments, so feel free to discuss in the Q&A section or reach out to your advisors, whoever is assisting you with the investment advice. So that would be all, Prabhu. Yeah, we can take up the Q&A now.
Yeah, thank you, sir. So the first question we have is, no, markets have all rallied. So is it a good time to invest in small and mid caps?
Yeah, so rally is there for sure, right? But there are two ways to look at it, right? Where we are on a relative scale, right? So if you compare, like I'll just answer the first part in a macro term, right? So if you look at the returns that the markets like US markets or Chinese market or European market has delivered in this calendar year, right? So for example, Dow has rallied close to 30%, right? If you compare that with the Indian market, we have not rallied anything, right? We have just grown 8% to 10% on a Nifty level, right? There has been a higher growth on the smaller and mid cap side, but that's also because of the fact that they have fallen much more in the previous correction, right? Now, secondly, if you look at the entire cycle of the growth, right? So last entire decade, India has underperformed the European markets, or we have hardly given a 10 to 12% kind of return, right? Which is way below our baseline return that the market is expected to deliver. So we are very confident that the next 7-8 years will be delivering return which will be way higher than the baseline return of 16-17%, right, on an index level. Specifically on the company specific level, right, where we are handpicking the companies which can have both the earnings tailwind and as the valuation a multiple rating opportunity. So there the return potential is much higher than what the index can deliver, right? And one sort of example is right in front of us in terms of super value performance till now, or for a matter of performance of any of the RHPMS schemes versus their benchmark, right? Secondly, the valuation, if you look at if you look at the valuation on a very relative basis with respect to the own bench, what historically we have delivered, right? So we are very fair valued in terms of what we have delivered, right? But if you look at the kind of earnings growth that the underlying companies is seeing, so that underlying growth in the earnings is again a good trigger for the valuation to come down. And when we enter into a rate cut cycle, so there will be the major play of valuation expansion that will happen, right? So normally when we enter into a rate hike cycle, there is a valuation or the multiple decline that we see in the economy, right, in the businesses. And when we enter into a rate cut cycle, so we see a valuation expansion happening. So we are due for the valuation expansion phase, right? So from here where we are currently, we have already seen 10-15% of valuation expansion. But from here on, from here to, let's say, the rate cut cycle, will again be seeing at least 10-15% of valuation expansion happening, right? So over the entire cycle, the valuation seems very favorable, right? And again, if you are a part of a high growth economy like India, so the longer your investment horizon would be, the lesser or the cheaper or the more attractive the stocks or the market will seem like, right? So if you're coming with an investment horizon of, let's say, less than a year, you should look at the valuations while entering, right? But if you come with an investment horizon of, let's say, 3 to 4 years, so this valuation is very comfortable from what we see, and we are very comfortable being 100% invested in the kind of stocks that we are holding. Yeah. Prabhu.
Yeah, thank you, sir. So the next question is, so do you see any rate hike in near term, and how portfolio companies are going to get impacted because of that?
Yeah, so rate hike, just 2 days back when the RBI meeting was, right, and RBI has come up with this policy, right? So we don't see any rate hike for the domestic market, at least, right? There was tomato inflation, which might give a slightly higher inflation number, but the rate hike will not be a factor of that. RBI is doing a lot of different measures to curtail the liquidity by increasing the CRR or something. But clearly, we are not intimidated by the fact that inflation is going to be a runaway inflation like what we are seeing in the developed markets, right? So maybe what could happen is that we'll see a slightly delay in the rate cut, right? So earlier it was expected that we'll cut the rates by end of this year. Now it's expected that maybe next February, March we'll cut the rates. So that could happen, right? There will be a delay in the rate cut, but rate hike for Indian market at least is off the table, and we'll not be seeing any rate hike happening.
The next question is, what is the manufacturing businesses that we are bullish on?
Yeah, Vijay will be answering.
Yeah. So in manufacturing space, we like a lot of themes, but we are also the very cautious about the risk part that it brings in. So in manufacturing, we typically like businesses which have high competitive advantages or the wide moat, and also the capital efficiency is there, and also the profit growth is reasonable enough, like the at least 2x of profit growth in the next 4 5 years. So we'll typically like spaces like wires and cables where there is no working capital challenges, and that there is a direct proxy of the capital goods expansion coming from the government side. Also, we like the paint space again, like where the infrastructure is going on. So we will also use a paint. It's also in domestic side. Also, we are seeing a lot of export demand coming from the Europe side for the premium paint manufacturing company in India. And also, we like the some of the spaces like the PVC pipes and the steel pipes, which are again the boost for the economy. So these are the three spaces like in manufacturing we typically find very much attractive to the other internal segments. Yeah.
Yeah, thank you, sir. So the next question is, what percent of our portfolio is invested in manufacturing?
Yeah. So if we talk about our the current portfolio composition, so around 45 to 50% is manufacturing based, that particular weight, and it comes from the themes which we have highlighted, like pipes, let it be PVC or steel tubes, wires and cables, or paints. So these are the themes like which are forming part of our the 40%, 45 to 50% of weight. So and balance is coming from 30% from the consumer discretionary side, 10%, 10-12% from the finance side, and 5% is from the pharma space or the healthcare space at a large. So that is how our current portfolio composition looks like. Yeah.
Sir, it's more regarding the strategy. So how does the performance sharing fee work?
Yeah, so if we mention about the current strategy or the superly aggressive strategy fee performance, so we have two models, but both are revolving around the performance fee sharing. So I will just quickly discuss a single part of it, which is the performance sharing. So let's say if if prospective client or someone invests 1 crore with us, and in the next 5 years, if the capital becomes from 1 CR to 2 CR, so we'll be charging around 20% of that fees, which will be around 20 lakh rupees of the profit. Of course, on the year-to-year basis, we will only charge when there is some positive performance in the particular year. Let's say if the portfolio has grown to 1 crore to 1.3 crore in the first year, so we will be charging around 6 lakh rupees on that, which is the 30 lakh profit. But let's say in the second year portfolio goes down by 5%. Let's say it comes down from 130 to 1.3 crore to 1.23 crore. So we will not be charging any fees. And in the next third year, if the portfolio goes up to 101.5 CR mark, so we will charge fees only on the 20 lakh of the previous high, which was the 1.3 crore. So it's a high water mark structure. Okay, so we'll be only charging fees for 1 crore at each new high for only once, and it will be 20% of the profit, 20% of the overall profit generated for the individual portfolio. So in summary, like 1 crore invested becomes 2 crore, the profit is 1 crore. So in the 4 to 5 year period, the total or the gross fee that will be deducted will be around 20 lakh rupees. So it's beneficial in the bear market, like we have seen in the last 14-15 months before the March 2023, there was mostly the negative or the lower drawdowns in the small and mid cap portfolios. Charging fixed fees over for us, it does not make sense because we are actually expecting capital inflows during those times. So we have strategically positioned this portfolio to more of a performance sharing, so that interest of us is always aligned with the interest of investor. And also we are basically it's a kind of close-ended kind of structure. Although SEBI doesn't allow us, but we have timed it in a manner that it protects our investors' interest as well at overall level from valuation point of view. So that is how the overall scheme will work like in terms of the fee structure. Yeah.
Thank you, sir. So the next question is, what is the expectation that we have on the performance on a 3 year to 5 year CAGR basis for the strategy?
Yeah. So from compliance point of view, we can't comment on the performance because SEBI doesn't allow us. But what we can comment or which is in our control is the earnings growth of the particular business that we have picked in our portfolio or the bouquet of the different businesses. So we are very confident of our portfolio to grow at least 20% earnings growth for the next 4 to 5 years. So typically what happens if your portfolio, the underlying theme is growing at 20%, so your stock price or price performance will be also in line with that. So one can reduce that. What can be the CAGR? It can be higher than the 20%. It can be lower than that. That's completely up to you how you want to take it. But for us, the portfolio earnings remain the single parameter for judging the success of our individual businesses that we have picked on our portfolio. So somewhere around 18 to 20% can be the portfolio earnings growth that we are very confident of from our businesses. Yeah.
So the last question. So what are the metrics RH uses to assess the growth and valuation in terms of fair value? Also, which sectors are depressed currently?
Yeah. So when it comes to valuation, so it depends on case to case. So different industries have different industry dynamics. How the portfolio, how the profit will go for a particular industry is significantly different from the other industry. So let's take example of the finance sector. So finance sector has all the assets mark to market basis. Mark to market basis. But if we take example of, let's say, FMCG space, so the assets are on the historical basis. Those are not mark to market basis. So the key, the fundamental is quite different for both the businesses. So we may apply price to book valuation parameter for the finance business, but for the FMCG we may go for the PE ratio on terms of relative value, or we can also go for the DCF because of the long-term nature of the profit. Because the FMCG can, a strong FMCG business or a brand can sustain the 3-4 decades kind of growth as well. So it depends on industry to industry. We use very wide parameters like in hospital and fashion retail or retail segment or the store expansion space. We typically use a E by EBITDA framework. Finance, it's price to book. Some of the longer term things like FMCG or the contract manufacturing, we may tilt towards P or the DCF. So it depends on case to case. And Prabhu, what was the second part of the question?
So which are the sectors that are depressed currently?
Yeah. So on the valuation side, if we are looking at the depression or the depressed, so the healthcare is again a very space which have been neglected for a long period of time, or the pharma at an overall space. So we had around 2 businesses coming from this particular space, and those have reported very solid earnings in the Q1 of FY24, and also it has reflected in the price performance. Another sector that we like is the building material, which is especially the PVC pipes and the steel tubes, because PVC industry had gone to the industry write-offs for the whole last year, and now the inventory gains have also, inventory write-off has already normalized. So we can expect like solid uptick in the PAT side. Similarly, for the steel tubes, there was some inventory write-offs for the last couple of quarters. Those will also get sorted out. So these are the some temporary distress which the businesses have seen in particular segments. So those can be like the particular space to interesting from the valuation point of view. Yeah, I would also like to like invite Prabhat to share his view in case he wants to add something on the depressed sectors idea.
No, that would be all, Vijay, right? So I think we can take the last question from here. So one of the participants is asking about the ticket size here, right? Like what's the ticket size we can have for the scheme, right? At what is the closer? So basically understand the super value aggressive scheme that we have launched to get the benefit of the tailwind in the economy and to get on the right side of the valuations. So mainly it's a very tactical play, right? It's not a long-term structural play that we can look to have in the portfolio, right? So the reason why it's a tactical play, because we found the valuations very attractive, right? And again, we are holding companies in this portfolio from the small cap side, micro cap side, and again we are holding companies listing got like which are listed on the SME exchange. So with that comes a very responsibility, huge responsibility of managing the liquidity around those companies, right? So that's why we have put a threshold on what would be the fund size. So if you go back and do a study, so every fund house which has a larger AUM, right? So like till 500 crore, if they keep on performing in a very good way, then AUM will chase that fund house, right? And when they become a 2000 crore or more, the fund size, so the performance of that scheme will go down because the opportunities will not be out there for them to invest, right? So that's why we have been ultra cautious here, and we have decided to curtail the fund size of this scheme to just 50 cr. We have already received around 80% of the commitment from our existing investors in this scheme, right? And we'll be looking to close this scheme for the subscription very soon by end of this month, right? So the reason why we are doing it, because we don't want to take any liquidity risk on the portfolio that we are running. For us, the prime agenda or like the prime task is to manage the returns for the client, right? And if we have a larger ticket size, and let's say like these are untested business model, right? So we don't have like some the business models to reference to, right? Like what could be the growth trajectory. For example, I'll just give a reference. We are holding a SME listed company in the portfolio which has doubled in the last 3-4 odd months, right? And that business is one of its kind. It's going to do 8x revenue next 4 or 5 years, but still we don't know how, like what would be the ideal valuation for this business to command, or what could be the growth trajectory for that business be, right? So we don't want to take unnecessary risk in terms of liquidity by increasing the larger ticket size or by increasing the exposure in the company, right? So that's why we have curtailed the, put a limit on the kind of AUM that will be raising. That would be just 50 cr. The other thing is that once the bottom return goes out, right? So for example, we have clocked around 36% return here. The moment will be crossing 45%, 50% return, the initial 45-50% return, then the return for the upcoming investors after that will be kind of very moderate, right? So we don't want that to happen for a client. So that's why we'll be putting a threshold that will not be onboarding any client in the scheme once the threshold of the CAGR return crosses 45%, right? Since inception of the scheme. So these are the two things we are keeping in mind for this scheme, right?